So the moral of the story is Micron should be making bank from all these NVIDIA chips. With NVIDIA's numbers coming in the way they're coming in, like, I don't see any reason why Micron shouldn't just nail it, man. Really nail it big. If the market, I'm telling you, if the market's up tomorrow nicely, that means there's no fear in this market at all right now. People are not scared at all. If there is a sell-off tomorrow, I would actually prefer a sell-off again tomorrow. Maybe not as hard as today, but another like red day for the indexes. I think that would be extremely healthy because that would show there's still fear in the market, which I think would be seen as a good thing. Like, ooh, people are still concerned, like, if we get another red day tomorrow. Hello, chat. We're about to, I'm about to pull up this Tom Lee. I'm going to restart where we started talking there because I know a lot of people just trickled in here. Let's see.
Talk of the tape. The continued bull case for stocks from FundStrat's managing partner and head of research, Tom Lee. He is with us here at Post 9. Welcome back.
Thank you, Scott.
What do you think? We just
hello,
got
chat.
a little,
hello.
You know, ahead of ourselves, or I don't know. Maybe we just need a breather because it's been remarkable.
Yeah, that's right. I wouldn't be surprised if there's some profit taking today. I don't think it changes the case that stocks are probably going to do very well between today and the end of the year, and we get a pretty important report on Friday, which is PCE deflator.
Yeah, you surprised that this market has continued to just ramp higher?
Woo! Look at that.
Almost unabated.
I think there was a sequence of events that justify the move because we know last week we got a Fed that has made a dovish move, ending its inflation war or shifting it towards managing the business cycle. We know that 65% of fund managers are underperforming their benchmark, and we know $240 billion was pulled out of equity. So between now and year end, which is a small window, you do have fund managers trying to catch up, and I think a lot of investors reorienting their portfolio towards a nicer Fed, a less hawkish Fed. And I think stocks are up. Investors need to allocate to stocks.
Unless investors need to take a breather themselves. I had a conversation yesterday with Eric Johnston of Cantor, who's been as bearish as you've been bullish, and told me he just can't show up now and all of a sudden change. Here's why.
I would not be able to come here and say high conviction bullish based on the current multiples, where we are in the cycle, where earnings are, where positioning are. Is just not even close.
Wow.
Okay. Well, what I would need is to see either a recession or close to a recession where people think that it's coming. We get a big growth scare, and the unemployment rate starts to go above 4%, a little bit of a cleansing, and lower prices.
In other words, you're going to get all bulled up, even more so now with multiples expanding to where they have?
Well, as you know, valuation isn't really why anyone should ever sell a stock, nor why they should buy a stock. It really should be whether earnings momentum is accelerating. And next year, it looks like capital spending is going to pick up. There's a lot of surveys showing this, and there's a gap between the hard and soft data. So there's a CapEx cycle. We also know mortgage rates could drop to something like a 4.75, 5.2 next year.
Well, that's not ahead of ourselves a little bit?
That would be taking a normal spread to the current 10-year. And that 200 basis point drop in mortgage rates, we know, would stimulate the consumer and reliquify regional bank balance sheets, which is an earnings story too. So I'd say earnings momentum picks up next year. We have a Fed that's trying to at least maintain the business cycle. And investors are bearish. There's a lot of anchored views. We just heard one clearly articulate that they're going to only turn bullish if there's a recession.
Yeah, but I feel like the bears are kind of dropping like flies now, right? I mean, there aren't that many of them. I've seen some strategists who were very bearish over the course of the last year.
Hey, on a day like today, they'll come back out of hibernation. You just watch. No, the bears are dropping like flies when the market's green day after day after day. But as soon as you get a day or two red, all of a sudden, believe me, the bears come out of the caves and they say, see, I told you guys.
Suggests, stocks can continue to go up. This Fed pivot is that powerful. The other side of that, though, is what Eric Johnston and others would suggest, that it's a little too early to think that earnings are going to live up to all of this hype. A lot of hype that you have. I mean, your earnings number last time you came
call
here,
him a hype beast.
The best case
for 2025.
Amazing case.
Yeah.
Unbelievably incredible case.
Yeah.
Like $280.
But
do I remember that correctly?
Yeah, you are, Scott, but that's not a prodigious feat. It's about a 10% CAGR. So it's like saying 5% from buybacks, nominal GDP, and weaker dollar get you there. I don't think it's a lot to ask to get to 280 in earnings. But I think most importantly, the market internals don't speak to what happens at a top. This is really early cycle behavior, you know, a huge expansion of market breadth. Stocks really peak when you get good news and they go down. We haven't had good news. I mean, today's sell-off isn't off some great headlines. It's just year-end rally.
Do you think the market is at all ahead of itself in the idea that there's going to be as many cuts as one would like to think based on what happened, you know, at the Fed meeting? I mean, I think the Fed is trying to figure out how to communicate future cuts. And the market's going to get anxious about it in the first half of next year. That makes a lot of sense to me because we're going from a data-dependent fighting inflation now to under what conditions does real rate get defined and when should we titrate that and cut rates? I think that's a debate in the first half. That's kind of why our 2024 view is most of the gains happen in the second half. Do you think we're pulling forward gains at this point?
Yeah. Yeah, I think December is going to end up very strong. And I think the last time I was here, I thought it could be parabolic, which it does seem like it's going parabolic. But a move like that isn't consolidated sideways, right? Maybe there'll be some payback in March or April.
I just want you to hold your thought for just a moment. I want to bring in John Spallanzani of the Miller Family Office, who is a portfolio manager there. He watches the market like a hawk. What do you make of what's happened here within the last 30 minutes or so of what you think is a culprit of this sudden sell-off? If there is one, anything more than just saying, hey, we've reached some pretty lofty levels, let's just take some chips off the table for a minute and catch our breath.
Hey, how you doing, Scott? Hey, Tom, how are you? Hope
Did they just slaughter somebody at the freaking stock exchange?
There was some big prints in the zero-date options, which is not a surprise. It's an expiration today. There's about a 500,000, almost 1 million calls and puts that printed a little while ago, right before the sell-off at the 475 strike. So that was also the VWAP level, which is you know, for those technical people, the weighted average price that guys are pegging for some orders. And then once we took out 475, it seems like selling just got selling and, you know, knocked us down 50 handles here. So, you know, we had a stair-step rally with nothing really hitting on the VWAP all the way from really kind of, you know, probably the 5th or 6th of December. So once we broke the VWAP, technical guys got to sell, and the options, the zero-day guys just kind of piled in.
I think it's just like maybe a little bit of an air pocket.
Interesting.
For a moment there.
Yeah, it seems so. You know, volume obviously is lighter as we get closer to Christmas.
True.
People taking off, and it was definitely an air pocket because we went up 50 handles pretty easily from 475 to 469.
Sadat said.
But you know, some people said that there was a couple of stories out there that might have done a couple of tweets that might have been put out there. You know, some China, some other stuff, but I don't think it was that. I think it was more, you know, the technicals and the zero-date options, which everybody's been talking about for a long time.
Look at that VIX spike up, just like that.
Levels. I mean, you can imagine what 1 million options that are expiring today, how much the hedge is if you got that trade wrong. So that's kind of
right. Yeah. That's like the latest and greatest trend as we're learning, I think, more and more every day in options trading, whether it's from the most experienced people who are out there to more novice investors who are trying their hand at options trading as well. I'm going to let you run. I think you're with me tomorrow anyway, so we'll catch up about the rally, where we think 24 is going to go. John, thanks for calling in. I just wanted to get some insight. Yep, just wanted to get some insight on just, you know, tick by tick here as we head over the final stretch. At this point, the market's come so far, so fast. I mean, bar's high. I mean, there's a lot now to live up to. You got to have the cuts when we think we're going to have the cuts. You got to have earnings live up to what now expectations are going to rise to. You got to have the economy hang in there to justify the multiple. You got to have rates come down to help justify the multiple. Is it too much at some point?
It's fair.
Well, you're describing a great wall of worry, and as you know, markets climb a wall of worry.
I know, but it's like maybe a wall of reality too.
Well, you know, I'd say that at the start of this year, a lot of the bear arguments you played for me earlier were exactly what people said on January 2023. we're going to have a hard landing. You can't buy stocks until employment goes up. Earnings are going to be disappointing. And the year played out, earnings were good, and we didn't have a hard landing. Look at labor supply. It's growing now, so I don't know if unemployment has to go up. And inflationary pressures are decreasing. Look at UMich, the Consumer Confidence Survey today. They're back to October 2020 levels. I mean, inflation is disappearing from consumer expectations. So I'd say that there's the thing that the bears might get wrong is multiples will do a lot more increasing than people expect next year.
All right, let's bring in Christina Hooper, sitting here as well from Invesco. This sudden move aside, what is your view as we sort of race towards the end of the year here with these extraordinary gains since November started?
Well, I think the key is that monetary policy, really since the Great Recession, has had an outsized impact on markets. It's really been such a critical driver of markets. And a perfect example of this is what we've seen this year. And especially what the Fed has communicated. If we look at the September dot plot, that implied 50 basis point cut after an implied 100 basis point cut in June was the start of a big rise in yields. And now, of course, we're getting the Fed communicating finally that we have actually seen the end of the tightening cycle in July. And that has had an outsized impact on markets, as it should, because monetary policy has been so important.
So you say it's so justified. I mean, we to your point, is we have, as an investor class, become conditioned to the don't fight the Fed. Because we've learned how powerful it could be after 08. And anytime there was any, crisis of magnitude, the Feds had our back. And the time they didn't, we had a terrible year last year because they were raising rates rather than cutting them. Now the paradigm has once again changed in our favor. That's the argument you're making. So this is all justified, the way the market's reacting.
Absolutely. And the economy is cooperating, right? We have an economy that has been quite resilient, and we also have disinflation very much underway. People were very skeptical earlier this year, and I think finally in the last few months there's a realization that the disinflationary process is happening. It's very significant, and we will ultimately get close to that 2% inflation target within a reasonable period of time.
Yeah. What about the broadening? The Russell, I spoke too soon, of course, when I said it was hanging on still a positive, because now it's rolled over with everything else. It's down about 0.5%, but it's been a remarkable run. The Russell, even with today's pullback, is up more than 11% over 1 month period of time.
Oh, absolutely. And I anticipate a continued broadening of the market. And I think small caps are going to play a critical role, as are cyclicals, because what they're doing and what the market typically does is it's discounting an economic reacceleration in the back half of 24. So it makes sense that the more cyclically sensitive parts of the market are performing better.
This is your playbook.
Yes, that's right. And then, when it comes to valuations, I mean, S&P 600's, 11 times next year's earnings. I mean, you could see a lot of multiple expansion there. That's why I think small caps could rally 50%, next year.
Yeah, you continue to make that case. At the expense of what? At the expense of what?
Well,
most people would say at the expense of maybe mega cap.
Yes, I think that's probably correct. That mega cap, actually, someone pointed out, and I think I actually checked it was correct. FANG's actually cheaper than it was at the end today than it was at the end of 2021. Because earnings have gone 100%. Up like 30% and the price level is only up 2%. But
yes, 100%.
Next year, 100%. The multiple can be harder to expand for the FANG, so it's just more EPS growth.
Yep.
Whereas things
100%.
like financials and small caps can see 50% increase in multiples plus earnings growth. So I think you're right. I think
100%.
If you're talking about PE expansion, it's more the small cap names.
Yes, sir.
How do you see that?
Well, I think it's at the expense of cash. It's at the expense of a lot of different asset classes. But
doesn't take a lot to move the smalls huge.
Is that
I don't
know what is going to happen in the back half of this year. In fact, I suspect what we're likely to see is a leadership shift and more of a focus on defensives and quality, because markets will be discounting 25. And maybe that's...
Not to mention a presidential election where who knows what's going to happen, how messy it might get.
He's going to get messy.
Right, and let's also not forget the long and variable lag of monetary policy. So if we use that rule of thumb that it's 12 to 18 months between monetary policy implementation and when we see it show up in the economy, well, that could mean it really hits in 24. We really don't feel the cumulative effects until the end of 24. So could we potentially see that recession in 25, which markets could potentially start to discount in the middle of 24? I don't know that yet. We just don't have enough visibility.
What if, I mean, I saw a headline, I think, earlier today from the Fed's Harker saying that, you know, the economy's slowing faster than the data is suggesting. What, in fact, if that is the case?
Well, I think, one, that sets up for a growth scare in the first half. And it sets up for the market to really be debating with the Fed about what they should be doing.
That goes into my thought process about a pullback in Q1, right? You know, like I said, they're going to look for some reason to have a pullback in Q1. At some point in Q1, they're going to have a big short-term pullback. They're going to be looking for a reason. They're going to blame it on whatever. Really, just keep in mind, it's a lot of people made a lot of money this year on a lot of stocks, and they're looking for a reason to take a profit. That's what it's going to be. But they're going to blame it on something. Growth scare, recession. They'll blame it on something. Oh, the Fed might not cut. I don't know. They're going to blame it on something. Trust me on that. But really, they just want to take a little cash at the beginning of the year.
That makes sense. That's why I think the first half isn't where you make your money next year. But does the Fed have the tools in place? I mean, Fed funds is at 5.5%.
So
they could do a lot of cutting, and they have a lot of.
That's a big statement by Tom Lee there. He's basically saying that he's expecting the first half of the year not to necessarily be great, but it's more the second half of the year. I think that's an important statement.
Tools to really stave this off. So.
But part of I would like to believe that part of the bull case is, yes, the Fed's going to cut. It's going to cut because it can. It's not going to cut because it has to. You're painting a scenario in which it doesn't matter. They have the tools. If the economy slows worse, if it looks like we may go into a recession, well, they're going to cut, so that's positive anyway. Is it really, though, if they cut for that reason?
It is, because it's one thing to be slowing if the consumer and corporates were over-levered. They're not over-levered today, but they're paying a lot of money to borrow money. So it's a cost of money
Micron
issue
earnings after the bell, by the
way. So if the Fed cuts rates, you're actually alleviating the biggest pressure valve on growth. So
but how do we justify multiples if the Fed cuts rates because the economy's gotten that bad?
Well, it's actually, that's one perspective, but the reality is they're cutting rates because real rates are too high. That's really what's, it's not appropriate to be at 5.5% if inflation's running at 2%, because you're running a real rate scheme that causes a recession. And I think, in fact, if we're slowing, it's proof that the real rates are actually too high right now relative to inflation, right? Inflation's tracking at 2%. So I think that there's going to be a bear argument, but to me, it's actually perfectly in alignment with the idea that inflation's falling, real rates are too high, the Fed actually has to make cuts. But that's a debate in the first half.
The idea that, there's no way this market is pricing in a recession. No way. I mean, we've already placed our chips all in the middle of the table that we're going to have a soft landing. We're placing our bets that the Fed's going to cut because they can, not because they have to. If they have to, does that change the whole paradigm about the market?
I think the question is moot because they don't have to this year. I think they're
in 24, you mean? This year,
yes, exactly. I think they start to cut in the second quarter because they should, because they admit they are in very restrictive territory right now. And so the reason for cutting is the right reason. Again, I think that what is undecided at this point, undetermined at this point, is what happens in 2025. But I anticipate something of a bumpy, brief landing in 24, a mid-cycle reacceleration, and then we could see more problems in 25. But it remains to be seen at this point.
What about, Christina, fixed income? Where are people supposed to be right now?
Well, if you anticipate a bumpy landing, as I do, I think investment-grade credit looks really attractive. Also, emerging market debt. It's a supportive environment in emerging markets. We're seeing a dollar that's weakening. I think that's going to continue. So those are two areas that are attractive. In terms of duration, long.
You have a view of that real quick before I go?
I think all that makes sense. I think bonds are going to do pretty well, but of course, if bonds do well, PE goes up.
Right. See, that's why you have a big smile on your face as you finish that statement. Thank you, guys, very much. Happy holidays to you both. We'll see you on the other side, I'm sure of that. Christina and Tom. All right, let's send it over to another Christina Partsinevelos, for a look at the biggest names moving in this market right now. And there are probably a lot more now than there were before, just given the makeup of this little sell-off we find ourselves in.
Yeah, it was a little shocking when I was just at my desk and seeing that switch right now. And that the stocks that I'm going to talk about don't pertain necessarily to that sell-off, but let's talk about CRISPR Therapeutics, because the chief medical officer is stepping down from her role only a few days after the company just received approval from the FDA for its Casgevy gene editing therapy, which is for the treatment of sickle cell disease. The regulatory filing assured investors there was no disagreement with the company. JMP Securities says CRISPR has sufficient backup to manage the departure and maintains its outperform rating. But you can see shares are down 7%, and to your point, Scott, falling just post 2 p.m. Let's talk about shares of Illumina. Lower slightly, they were higher. So again, to your point about the downturn in the markets, after the company said on Monday it would sell its cancer screening company Grail because of antitrust issues. Activist investor Carl Icahn wasn't happy about this purchase either in the first place, and he said he now plans to oust board directors because of that deal specifically. So you can see it's fairly negative at the moment. Scott?
Yep. All right, Christina, thanks. We'll be back in just a moment with you. We are just getting started here. We're all over the market as well as it shifts towards the downside here. Dow heading for its first decline in some 10 days. That's the kind of market we've been in. Now, Warren Pies of 314 Research joins us after the break with his take. We're live from the New York Stock Exchange.
My favorite porn star.
You're watching Closing.
At the moment, yes. I think there's been a pretty important change in the markets that I don't believe everyone has fully appreciated, really going back to late last month. And
he's got to film a scene right after this is over.
I don't see it as nothing. And there's nothing really, no signal in this move yet in my mind. So no, I just think this is a healthy pullback, as they would say.
100%. Yeah, I'm surprised it's not bigger. That's what she said. I'm surprised it's not bigger in terms of this pullback. I figured like when we finally got one of those down days, it was going to be like a 2 to 3% type down day. I mean, it's just like everything that's been going up a lot is what's pulling back heavy today, right? You know, what did my eyes go directly to when I pulled up this housing watch list? My eyes directly went to one stock. Siggy, yes. Enphase. My eyes went directly to Enphase first and foremost before I really even saw anything else. And the reason I went straight to Enphase is because Enphase has been red hot for the past about a month now. You know, Enphase obviously had that huge drop from, $300+ all the way down to the $80 something range, right? And then the past month, Enphase has just been red hot, right? But you look at it on a day like today, obviously it gave up, some of those gains today. And so that's what you're seeing across a lot of these watch lists is just some of the hottest stocks have been some of the ones that got hit the hardest. I mean, look at, my watch list here today. Look at the stock that got hit the hardest. Fubo. Fubo's been red hot. Look at Elf. Elf's been red hot. The stocks that are really getting hit the hardest today are the ones that have been roaring the highest, right? Yeah, looking into Micron here for a moment. They report after the bell. So Micron, their memory chips go into just about everything. I mean, it's insane. I'm curious about their chips into their memory chips in AI-related products, right? Because from what I remember hearing, I got a friend who's a big shareholder of Micron. He always would tell me about how much money they're going to be making off AI-related chips. NVIDIA, for instance, recently announced an update to a widely popular H100 AI processor. The updated H200 AI graphics processor is equipped with the latest generation of high-bandwidth memory, known as HBM3E, which is reportedly much faster than the previous generation. NVIDIA points out the H200 processor delivers 141 gigabytes of memory at 4.8 terabytes per second, nearly double the capacity and 2.4 times more bandwidth compared with the predecessor NVIDIA A100. It is worth noting that it isn't only the chip with larger memory that NVIDIA has recently launched. In August, semiconductor giant announced the GH200 Grace Hopper Super Chip, which is equipped with a massive 282 gigabytes of HBM3E, an increase of 3.5 times over previous offering. So the moral of the story is Micron should be making bank from all these NVIDIA chips. It is slightly tempting me as a gamble. It's slightly tempting me. Let me look at options here. Micron usually doesn't move big on their earnings. That's the thing. Like Micron usually is a, 3 to 7% type move. So that's a tough thing. But it is a little tempting. I mean, if they announce some sort of epic guidance, big EPS beat on the bottom line, I mean, could the stock climb to $85, $90 tomorrow? Sure. But also, are they going to do that, right? So it's very tempting. Very tempting. We'll see. We'll see. Not going to make a move there, but should be interesting. I'm looking really forward to seeing what these earnings are they report, though. That's the bottom line in regards to that. With Nvidia's numbers coming in the way they're coming in, like, I don't see any reason why Micron shouldn't just nail it, man. Really nail it big. All right, here we go, into the close.
Is watching Micron today. Those earnings are in OT. Get your first word, though, Mike, on this rollover we've had late in the day.
Yeah, I mean, the market in so many ways was wound very tight. We were talking about all these streaks, right? Up 7 weeks in a row, the Dow up 10 days in a row. Frank Capillari, technical strategist this morning, pointed out that for 9 straight days and 13 of the last 14, the S&P 500 closed above its midpoint for the day, meaning we had these late day rallies. It was on autopilot. So with that as the backdrop, normally once you get overbought and keep going higher, I think it just makes things a little bit vulnerable in the short term, not really in the longer term. We cracked those levels you were talking about earlier in the hour.
Dow getting close to a 400-point drop.
Once the game changed, once the pattern of late day bid and this autopilot execution programs did not show up, it was sort of like, okay, game over for now. We have to reset. I don't think there's a lot of real damage done, but maybe we changed the rhythm of this market just a little bit. We first crossed above 4,700 on the S&P a week ago, and so now we've kind of retraced back to that, and we'll see if that's enough to take some of the froth off.
Take you away from this conversation for just a minute. We're following some news regarding Citigroup. Hugh Son has that for us as the overhaul by Jane Fraser continues, it appears, Hugh.
It is, Scott. So the latest from sources with direct knowledge of the situation is Citigroup has
just crossed a
decided to
5%
kill
down
yet
move.
another Wall Street business with many decades, in terms of the markets. So it is calling the distressed debt business. Now, for those who don't know, that is essentially the bonds and other instruments of companies that are in bankruptcy or approaching bankruptcy. They've been, experiencing a lot of turmoil in this business since 2008. Lots of co-heads, lots of departures, people leaving to start their own hedge funds. And finally,
nice downward move for Nvidia today.
Jane Fraser's overhaul of the business.
I might have to
she has
start a position
decided
soon.
to cut bait, to kill this business. There are approximately between 30 and 40 traders and salespeople, other highly paid individuals in this business who will learn in the next few days that they are being let go. Scott.
Hugh, I appreciate it. Thanks for the update. We'll continue to watch that stock as we head towards the close down 1.5%. Hugh Son with that story on Citi for us. Deirdre Bosa.
Looks like a pretty healthy pullback to me.
My screen here, except for Alphabet.
Yeah, that's right. It is one of the biggest S&P gainers today, and that's really on the back of a report that says the company is already monetizing AI in its ad tech business. The information, citing a source, puts a number on one AI tool in particular, saying it will generate an additional $15 billion in search ad revenue per year, and that can ease investor worries about the impact of AI on Google's broader search business and potentially give it room for Alphabet to cut costs further. The report also says that Alphabet is planning a reorganization to rely more on such tools, so less actual salespeople would bring costs down. It could also help as Google faces challenges to another less profitable part of its ad business that, of course, is subject to a DOJ lawsuit, and that is going to play out next year. So that green on your screen, that's Alphabet.
Yeah, appreciate it very much. Deirdre Bosa, thank you. I've got red on my screen from Micron, Christina Partsenevelos, and that's...
It looks like the sell-off's getting a little heavier here into the close.
Well, let's start with the positive first. You got the long period of sustained declines for memory prices overall, but we're starting to see a little bit of an uptick in memory, and that could be a driving factor for Micron. 3 reasons for that: generative AI models, which require high bandwidth memory, which sells at a higher price point, stabilization in PCs and smartphones, and lastly, the general cyclical nature of customer inventory levels. starting to come down.
Appreciate it.
Which sounds like a nice setup for
Rock
Micron,
on, baby.
But to your point, Scott, the company already pre-announced on November 28th, and although they increased their Q1 revenue guidance, it's their higher than expected $990 million in operating expenses that remain a big concern, and why they are expected to operate at a loss. Micron CEO warned at a recent UBS conference that the higher expenses were due to the timing of R&D and asset sales. Investors will also be looking for signs of a gross margin recovery. So that means today, Scott, at just post 4 p.m. Eastern, all the focus will be on the February quarter guidance for gross margins, with the bulls looking for further signs of improved memory pricing to help keep the...
So when NVIDIA's business was a lot smaller, they were very affected by crypto, right? I don't think they're nearly as affected nowadays. If I recall, Ethereum runs completely differently now, and so from my understanding, you don't even need NVIDIA chips for Ethereum mining. So, ooh, MU, nice move up. I should have played those calls for a gamble at, shouldn't I have?
And the tech sector is up about 50% for the year. Financial services and a lot of non-discretionary
hype train
sectors.
We haven't had a hype train in like a week or two.
However, if we think forward to next year and what it means for interest rates, different companies, different sectors have very different balance sheets, different dependence on borrowing.
Russell closed at the
very
lows.
Different earning sensitivity to interest rates. So I think what we'll see is a big broadening of marketplace growth, of the stock market growth, instead of it being concentrated in one sector and specifically being a very narrow band of performance.
I don't think they've gone over the Micron earnings yet, have they?
I do think that the lower interest rates will benefit many, many different industries and many different sectors. So the broadening will be quite healthy.
All right, we'll talk more about that in a minute. But for now, Micron earnings are out. The stock higher by about 3.5%. Christina Parks-Nevelis, how do the numbers look?
Well, investors are getting that recovery story that they were looking for. For their adjusted loss per share, they did lose about 95 cents, which is stronger than what the street was anticipating, on revenues of $4.73 billion. Also a beat when we talk about Q2 guidance, $5.3 billion, much higher than the $5 billion anticipated by the street.
Nice.
With an adjusted loss of 28 cents for the second quarter. That's much better than the 62-cent loss that the street was anticipating. Gross margins was a major concern. There was talk about gross margin recovery. We're seeing gross margins come in for this Q1 quarter at 0.08%.
It's kind of what I thought was going to be here.
8%, so it's not negative, a little bit positive there. And I'd like to just point out that much of this beat has to do with stronger pricing from the company. They said that as well. The CEO saying we expect our business fundamentals to improve throughout 2024 and record industry TAM projected for total addressable market. All you need to know is that the recovery is underway. Memory prices are improving with this report. Scott, John?
All right. Christina, thank you. Got to mention, Micron's CEO is going to be on Squawk on the Street tomorrow morning, an interview you don't want to miss. Sanjay Mehrotra.
So
and that guide.
That's kind of what I thought was going to happen there with Micron.
Because, Morgan, they did release the results for the current quarter, or the past quarter, I should say, a little earlier in November. The guide is what people were concerned about, and that did come in better.
That's right. There had been that pre-announcement. And, of course, commentary, perhaps not surprisingly, given the year that we've had and the environment we've been in.
Yeah, so what I expected pretty much happened as far as Micron went there, right? Business is stronger than people anticipated, and they're going to be more profitable. At the end of the day, NVIDIA's making bank right now. If NVIDIA's making that sort of money, you believe me, Micron's going to make crazy money too. Should be a really good year for Micron's business model. The stock price is a debate, but in terms of the business model for Micron, should be really, really good. Tomorrow's huge. If the market, I'm telling you, if the market's up tomorrow nicely, that means there's no fear in this market at all right now. People are not scared at all. If there is a sell-off tomorrow, I would actually prefer a sell-off again tomorrow. Maybe not as hard as today, but another like red day for the indexes. I think that would be extremely healthy because that would show there's still fear in the market, which I think would be seen as a good thing. Like, ooh, people are still concerned, like, if we get another red day tomorrow. But I'm telling you, if we get a big bounce back day tomorrow, all the indexes are green, that just shows people are not scared of anything right now. And all the market wants to do is go higher, higher, higher. So, now tomorrow we're going to do a Beast live stream, and the reason being is Nike's reporting after the earnings, after the bell tomorrow. So I'm going to go through Nike's report in depth tomorrow with you guys. We'll look at the income statement and balance sheet in depth of Nike that they report tomorrow. We're going to also listen to a conference call And the reason I want to pay attention to Nike, I do own some shares of Nike, but the other big reason is I want to hear what's going on with China. Nike's a big player in China. And if you don't know, I'm considering actually starting an investment in Alibaba. And so I want to get some intel on what's going on in China. And I think Nike's one of the best tells in terms of understanding what's going on with the Chinese consumer right now, how they're feeling, how they're spending or not spending. Are things improving or are things getting worse, right? And so I'm really going to be, excited to kind of hear those Nike earnings tomorrow. But the thing I'm looking the most forward to is honestly just to see market reaction tomorrow. Do we get a red day or a green day, right? Alrighty, guys. Much love as always. Appreciate y'all being here. And other than that, see you on the main channel. Peace.